so much for attending today's National Mortgage Professional Magazine webinar. Today we're featuring a very interesting topic that is about an unused loan program that people are amazed when they hear the details about this program. This is the IRRRL loan. This is that's a VA, and it's IRRRL. And the name of this webinar is Helping Our Veterans While Helping Our Business. When we wanted to do a webinar on the IRRRL loan, I reached out to one of the experts in VA loans, Remen, and I got my good friend Joe Amoroso on the line. Joe, are you there?
Yes, I am.
Joe, thank you so much for participating in this and offering your resources to help educate our readers on the IRRRL loan. Just to get started, I want to get an idea of the kind of people that we have here on the call. So, everyone, if you can just answer these questions. For VA loans, are you originating as a direct lender or a mortgage broker? Or if you're just another mortgage professional, just answer these questions right now. So if you could just, on your screen, there's a poll with the 3 answers. Just click your response on that. Great. I'm gonna allow another 10 seconds for this. Look like it's mortgage broker seems to be the winner in this right here. Great. Okay. Fantastic. I appreciate that. Just I'll share that with you guys, just so you can see, who else is on the call. So very cool.
Yeah.
Now,
yeah.
Joe, before we get started, I also want to find out, how much experience the callers have with IRRRL loans, because it's obviously this is not a new product. This is a product that's been out there for some time, but I'm going to put that poll up there, and right now, if everyone could just answer this, 3 responses on that. Hey, Joe, look at this. Right now, it looks like 10% of the people, are regularly doing IRRRLs.
Good opportunity there.
Yeah, I think so. I'm going to leave another 5 seconds on. Okay, great. I'm going to close this out. So yeah, it's pretty interesting. As 43% of the people on the call have never originated an IRRRL loan.
Wow.
Well, that means there's an opportunity for a lot of people on this call to learn about it today.
I think so. And with that being said, Joe, listen, I'm going to pass the mic over to you if you can take over here.
I appreciate it very much. Thank you, Andrew. And I'll start off by thanking Andrew and the National Mortgage Professional Magazine for allowing Remen to participate in these webinars. It's a terrific thing for all of us, and we appreciate his allowing us to do that. And I'd like to thank everybody for joining us across the country for this. We appreciate your attendance, and it is not forgotten. We appreciate that. Let's talk a little bit about what our thoughts are on the whole webinar process. We feel here at Remen that education is one of the most important things we could possibly do to kind of navigate our way through these very difficult times and crazy times in the mortgage business. And we think that education plays a huge role to each one of our success. And that's why we're making sure that people we reach out to people through these webinars and make them understand how important education is, education about what's going on in our industry and education about our products. Back in December, we did another one of these webinars on the 203K product, and it was incredibly, I can't think of a better word to say, it was incredibly well received. It was, we got tons of very good feedback on it. I felt like we also served a nice little purpose by educating a lot of people about that product. And here we are today, going to do the very same thing to talk about the IRRRL product. So let me take a moment to introduce some of the people that are on this call. The primary person, the primary presenter, is Mrs. Pam Seifert. Pam, if you were on another webinar of ours, perhaps you've heard Pam speak before, but she's been in business for over 21 years. She has had her staff appraisal VA designation since 2000 and has been a D underwriter since 1999. Currently, very happy to say that I get to work, luckily get work very closely with Pam, as she's the training manager here at Real Estate Mortgage Network, and the director of training, I should say. And we're happy to have her with us as the primary presenter on this call. Additionally, we have a couple other people that are on the panel there that will be answering questions for you. We have Ann Stadorudis. Ann is Real Estate Mortgage Network's wholesale underwriting manager. Ann has been in the business for a real long time, since 1970. She was on the New Jersey Mortgage Bank Association FHA chairperson as well as conventional chairperson. Lots and lots of experience. She's on the call with us to answer questions. And we also have with us Cheryl Arellano, who is Remen also. She's currently, for the past 5 years, she's been working with veteran borrowers to obtain home loans. She's an underwriter here at Remen, and she also has her staff, or as it's known, SAR, appraisal reviewer designation with the VA. So she's been with us a long time as well, and we have 3 really distinguished panelists here. And that having been said, we'd like to jump into the meat of this thing, and I will turn it over to Pam. It's all yours, Pam.
Great. Thank you. Thank you, Joe. Thank you, Andrew. Thank you for all who have participated in this presentation. We're going to get started, and we're first going to talk about what an IRRRL is. First of all, the acronym for IRRRL is Interest Rate Reduction Refinance Loan. And simply put, the IRRRL product allows borrowers that are currently have a VA mortgage to refinance in order to lower their principal and interest with little documentation, which you're going to see throughout this presentation. You will be surprised how little documentation the VA does require to have your veterans approved for this program. Like we said, it's VA to VA refinance only. So therefore, if you do have a veteran borrower and they have a conventional file, a current mortgage, or FHA, USDA, they will not qualify for an IRRRL, but they still can do a refinance through the regular VA product. The VA wants to help their qualified veterans with home loans, and you'll see that throughout the Lander's Handbook for purchases, refinances, and especially for the IRRRL product. Essentially, what they want to do is they want to take their veteran borrowers who are paying their current mortgage, and if we're able to provide them a lower monthly payment, that's really the thought process throughout the program, is if we could put our veterans in a better position and they're currently paying, then that's what we want to do on an IRRRL. It is going to be one of your last 2 streamlined products. So there is little or hardly any documentation required, because once again, all we're really trying to do is putting our veterans in a better position. As always with all programs, you want to check your lender's guidelines, because sometimes they do differ from what is outlined in the lender's VA handbook. Throughout this presentation, what we're going to do is we're going to highlight some of those differences, some of those key points, so that when you are originating IRRRL products, you want to make sure, or any VA product, you want to check specifically for these certain points against the guidelines. So going right into documentation is a streamlined process. So there's no income verification required. Now, some lenders do require a telephone verification of employment, or they may even ask you to list the employer on the page 1 of the 1003, but page 2 of the 1003 under the income will remain blank, because there is no income required on this product. There's also no asset verification required either. The only time you're going to verify assets is if the veteran needs to bring funds to closing. And we're going to talk a little bit about closing costs and what exactly the borrower needs to bring to closing in a couple more slides, but really there is no asset verification. This is a big one, no credit. Now, the VA Lender's Handbook states that you need to make sure that the veteran is current on their mortgage. Now, most lenders are going to require at a minimum a mortgage-only credit report to ensure that the veteran is current on their mortgage payment, or your lenders may even require a full credit report. but you do need to provide evidence that the veteran is current. And really, the only way to make sure that the veteran is current is by checking a mortgage-only credit report. Now, if the veteran is not current, that doesn't automatically mean that they're not able to get an IRRRL product. That loan is going to have to be sent to the VA, to the regional center, for prior approval. This is another point where you want to check with your lender to make sure that they're able to do those loans where a veteran is not current, even if they get prior VA approval. Veterans with recent Chapter 13s may need a trustee approval. That's the only other portion of the credit underwriting. But generally, there is no real credit underwriting for IRRRL. Because we don't have income and assets, there's no ratios on these loans. This is a big one, the no appraisals. Now, the VA does not require appraisals on IRRRLs. Once again, they feel that if the veteran is paying their mortgage and we're able to lower their monthly payments, then the veteran should qualify for that IRRRL. Now, some lenders, or most lenders, I want to say, do require some type of value analysis. So check with your lender. For example, Remen does require for loans under $417,000 a 2055. That seems to be standard throughout the industry, so please check with your lenders. Because we don't have ratios, we don't have income, we will not have an appraisal, we're not running any automated underwriting system. So no DU, no LP, no total scorecard, no AUS is required. The funding fee is the same type of fee that's required on FHA loans as the upfront mortgage insurance premium, or USDA requires a guarantee fee. The VA requires a funding fee. It's treated the same way where you have a base loan amount. The funding fee is going to be included in the total loan amount. You're going to add those together to get the total. Now, you'll notice on an IRRRL, that funding fee is 0.5%. That is much lower than your FHAs, your USDA loans as well. So if you do have a veteran that has a current VA mortgage and you can go the IRRRL route, you will see you will be able to save them a lot of money up front. The other thing is that there's no MI, monthly mortgage insurance, on any VA product. So purchases, refinances, and IRRRLs, no monthly MI. So that's quite important as well. Borrowers that don't have to pay monthly MI, it will continue to keep their monthly payment lower. The minimum guarantee is 25%, which means the VA guarantees 25% of the loan amount. Now, for those that have done VA loans in the past, you know when you get your certificate of eligibility, the VA uses part, or the veteran uses part of their original entitlement. That does not change. So if they use a total of $36,000 as part of their original entitlement, that $36,000 is going to remain the same on the IRRRL product, so there's no difference there. And as of January 25th, 2012, the certificate of eligibility is no longer required on IRRRL. Now, the VA does not make a lot of changes on any of their products. And speaking with a lot of people in the industry, a lot of people have said to me, loan officers, I haven't done a VA loan, I haven't done an IRRRL in about 10 years. Well, the good news is that not much really has changed in the past 10 years. The VA really keeps the handbook consistent, and they don't make a lot of changes. There's not a lot of updates. There's not a lot of circulars. Like for FHA, we get mortgagee letters, which provides updates to the program. For VA, they send out circulars, and there's not many circulars per year. So if you haven't done a VA loan in quite a while, now is the opportunity to jump back in. And for those who've never done a VA loan, starting with IRRRLs is a perfect way to get your foot wet. So here is the meat and potatoes of the IRRRL product. Your proposed principal and interest must be reduced, or the loan term must be reduced. So when you are looking and talking to your veteran borrowers, looking at their credit, looking at their mortgage-only credit report, you want to see the breakdown of their principal and interest. You want to compare that to what your proposed monthly principal and interest is. If that is being reduced, then generally the veteran can be approved for an IRRRL loan. The exception to the P&I being reduced or the loan term being reduced is if you have a VA loan that's currently an ARM or graduated mortgage payment. If you're changing that to a fixed rate, then that's the exception to those being reduced. The caveat is, though, however, if the principal and interest is increasing by more than 20%, the VA Lender's Handbook requires lenders to make sure that the veterans qualify for the new payment. They require that that the veteran qualifies for the new payment. Now, how are we possibly going to do that? Really, typically, lenders require full credit under credit qualifying files. So if you have an increase in your PICI more than 20%, then you will have to have your income, your assets verified, your credit, full credit report, and so forth. Be careful of the term of the IRRRLs because they are not allowed to exceed more than 10 years from the original term. So if you have a VA loan with a 15-year, for example, your max term that you can do on an IRRRL is going to be 25 years. And you can never exceed 30 years and 32 days. So this is something that a lot of people don't know, the exception to the VA occupancy rule. VA purchase and regular refinances require veterans to occupy the property. The IRRRL is an exception to that rule. The veterans don't currently need to reside in the property. However, the veteran needs to certify that the subject was previously occupied, and the VA will accept that. The veteran, however, must still own the property and stay on the new loan. That is a big thing for the IRRRL, so please make sure that the veteran that was originally on their original loan is going to remain. For example, if you have a divorce situation and the spouse is being removed, the veteran can still apply with an IRRRL loan without credit qualifying as long as the veteran stays on the mortgage and the title. If the veteran has died and the surviving spouse was a co-obligator on the original loan, the spouse is considered a veteran for the purpose of the IRRRL. So even when you're speaking with veteran spouses, that if the veteran has passed away, you could still do an IRRRL on that property if the VA mortgage is current. The veteran statement is required. The VA is very clear in the handbook to make sure that the veteran understands the new loan that they're going to be originating and they're going to start. They're required in each loan file. It's the veteran statement. I've heard it called either a VA rate reduction certificate or even an old versus new statement. You may hear it from your lenders many different ways. But basically what it is it compares the old monthly payment to what the new payment's going to be. And it also includes the number of months it's going to take to recoup the closing costs. So that's going to be required in every loan file as well. And like I said, that's typically done as either a rate reduction certificate or an old versus new statement, but it has to be signed by the veteran and it has to compare the old versus new payments. And like I said before, the number of months it's going to take to recoup those closing costs. Now at this time, Andrew, we do have our next poll question.
Okay, let me launch that right here.
Andrew?
Yep. Okay. Here we go. Pam, it's launched. I have it up there right now.
Okay. I actually can't see it because I have the showing my screen right now, so I can't see it. So if you can let me know what everybody says, that would be great.
Okay. So right now we have, we're basically asking the attendees how much cash they think the borrower is allowed back at the time of closing. So right now we're asking the attendees this. Let's see how many people have responded so far. So right now we have 60% of the people have already responded. We're going to keep this open for another 10 seconds when we'll come up with the answer that everyone has given, and then Pam, you'll tell us if that is accurate.
Okay, I'm sorry. What was the majority of people? What did they think?
So, okay, I'm closing this right now, and I'm going to share the results. Okay, so when we asked the audience how much cash is the borrower allowed back at the time of closing, 24% said none, 56% said up to 500, and then 20% said 2% of a loan amount up to $2,000.
Well, our 56% of people were correct. You are able to have up to $500 back for incidentals. And on the next slide, we're going to show you how to calculate the maximum loan amount and talk a little bit about that. Great. There is a VA form called 26-8923. Now, anyone can Google that, but it's your IRRRL worksheet. And the basic premise of this is how to figure out your max loan amount. And what you're going to do is you're going to take the existing VA loan payoff, allowable VA closing costs, and I'm going to stop right there real quick and talk a little bit about allowable VA closing costs. The VA still has a list of allowable costs you're able to charge your veteran and what you're not allowed to charge your veteran. And we do have a slide pertaining to that, which we will cover. So going back, it's your existing VA loan payoff, your allowable VA closing costs, add that together with your VA funding fee, which is the 0.5%, which I failed to mention before as well with the funding fee. If your veteran has a service-related disability, that funding fee actually may be waived. So you do want to talk to your veteran borrower about that. So if you do have a funding fee, you're going to add that in. And then you can have up to 2 reasonable bona fide discount points. You're adding all of those together, and that's going to be your total loan amount. That's how easy it is to calculate what your max loan amount is on the IRRRL. You are only able to pay off the first lien. Because this is a true streamlined product, you're not able to add in any second mortgages. So those are going to have to be subordinated. So when you're looking at credit reports, when you're looking at title, just be careful that if there is a second mortgage, you must subordinate those. And as we said before with the poll question, there is no cash back at closing to the borrower. However, there is allowed up to $500 for just incidental charges. Now, the exception to the no cash back is going to be your energy efficient mortgage product. Now, you are able to add an EEM on with an IRRRL. So we're going to talk a little bit about that a little further because that's a great, it's a great product as well to add with your IRRRL. So going back to your VA allowable closing costs, the VA does, like I said before, have a list of allowable and non-allowable closing costs for all VA home loans. So you can go on to the VA website and get that list, and you will see what you're able to charge your veteran and what you're not able to charge your veteran. And I do want to let everybody know that even on VA purchases and refinances, the allowable and non-allowable closing costs do apply. Now, anyone can pay, and when I say anyone, I mean the sellers or a broker can pay for any non-allowable fees. We're just not able to charge the borrower, the veteran borrower, any non-allowable fees. Now, as you're originating these loans and you're putting together your good faith estimate to show what the closing costs are, the veterans can pay a 1% origination point, but if you choose that option, then you are not able to charge the veteran any unallowable closing costs. So if you go into line 801 and block number 1 on the GFE, you're able to charge a 1% origination cost, but then you have to look at that list of unallowable, and you're not able to charge any of their unallowable costs. Or you have another choice. You can charge up to 1% of the loan amount in unallowable closing costs, but then you're not able to charge an origination point. So you have a choice there, or your third choice is sometimes a blend of both. Say, for example, if you want to charge a half an origination point, and then you could charge a half a point of the loan amount in unallowable closing costs. So you really do have a choice there of those three options of what you're charging your borrowers, but you do need to be careful of what you are able to charge the allowable closing costs and then the non-allowable closing costs as well. And I know that could be tricky, but the more familiar you are with VA loans, this is the same for purchases, refinances, and the IRRRL product. So going back to your EEMs and adding them to your IRRRLs. Now you can add up to $6,000 of any energy efficient improvements to your total loan amount without prior approval from the VA. Now someone asked me just the other day, well, how do you figure out the LTV on the adding when you have it adding an EEM to an IRRRL? There is no LTV on these. So there is no max LTV on an EEM adding to an IRRRL, but once again, you need to check your lenders to see whether or not they may have some type of LTV or CLTV cap. Now the EEMs are broken down into three different buckets for the VA. When you have an energy efficient improvement from $1 to $2,999, the VA does not require any additional documentation other than the information regarding the energy efficient improvements. So there's no qualifying the borrower, there's no checking anything, you can simply add that EEMs to the IRRRL. The second bucket is the $3,000 to $6,000 bucket. If your energy efficient improvements fall under that bucket, then you need to send to your lender the EEM improvement documentation, and then you also need to prove that the increase in the monthly mortgage payments do not exceed the likely reduction in the monthly utility cost. So what that basically means is that what you're going to do is you're going to look at the monthly mortgage payments, what it would be without the EEM, compare it to what it is with the EEM, take that difference of what the EEM portion is, and that has to be less than what the cost is to do the improvement. If that meets that test, then you can add up to $6,000 to your IRRRL loan for the EEM. For learning more about EEMs, you can go to the VA Lender's Handbook. There's a chapter that you could take a look at for those. I believe it's Chapter 7. Anything over $6,000 on the EEM, though, does require prior VA approval, so those loans do need to be sent to the VA. Now, when you are adding your EEM improvement onto the IRRRL, just remember that 20% rule, which is any increase in the PITI over 20% does require that the lender verifies that the veteran qualifies for the new mortgage. So just be careful when you're adding the EEMs. Once you hit that 20%, you need to credit qualify the veteran to make sure they can pay for that. If the EEM falls underneath that 20% rule, then you're good to go, and the IRRRL guidelines apply with no income, no assets. So one of the things we wanted to cover here is how to attract new VA business. And I did reach out to an organization that deals with military families, and I asked them for a couple suggestions as well. Some of them were to advertise your services with your local military bases if you're located near one, or checking out American Legions or local VFWs. Those are perfect opportunities to get in touch with your veteran community. Your imagination of trying to get in touch with the veteran community really can be limitless. You can visit these organizations to provide lunch and learn, using the IRRRL product. You could provide press releases in the local newspapers and veteran newsletters, letting them know that you are a loan officer that wants to do business to help out the veteran community. You can also go to your local community and business leaders and let them know your involvement with the VAs, helping them with their home loans, and ask for their help. Communities want to help veterans, and I'm sure that you'll be able to get something perhaps even donated, like a free dinner or a movie on move-in day for your veterans, and make a big deal when you do have a VA purchase, refinance, or IRRRL product. You are helping the veteran community. And then, of course, there's always business lists that you can buy that concentrates on the VA businesses. Another thing that you can do is you can become that person that's a VA expert. So how do you become a VA expert? You can use certain organizations and their information to help you achieve this, such as USA Cares. Now, this is a non-for-profit organization that provides financial and advocacy assistance to U.S. personnel, veterans, and their families. They have a free online military housing specialist course for mortgage industry professionals to take. And this course will help you understand how to work with the military, including ranks, as well as understanding the military pay stubs. Military pay stubs are called leaving and earning statements, and anyone who has done VA business in the past and have taken a look at the leave and earning statements know that they could be quite confusing. This course, which is free online, breaks down how to interpret and understand the leave and earning statement. And once you successfully complete this course, you're going to be listed as a certified mortgage housing specialist and even can advertise using that course seal. So to register for that course, we have a website here that you can click on, or you can contact directly the program director for USA Cares for the Certified Military Housing Specialist. For brokers trying to earn some VA business, just to let you guys know that the VA does not require any prior approval for brokers. What you need to do is you need to contact your lender, a sponsoring lender such as Remen, and we need to submit a $100 fee annually to the VA, and the lender has to request to add that broker onto their list of agents. It's as simple as that to start your VA business. For additional information, I have some websites here. We have www.va.gov, and under Veteran Services, you can click Home Loans. That's going to take you to a large amount of information, and including the Lender's Handbook, which has all of the VA guidelines in there for every type of loan, purchase, refinances, and IRRRL products. There's also the Veterans Information Portal, otherwise known as VIP. We have the link there as well that also has a lot of VA information on all their programs. You can sign up for VA announcements, the circulars, and trainings at your regional loan centers. The U.S. is broken up into different regions for the VA, and they offer free webinars and also free seminars at their local regional centers. You can contact your lender for additional information, which we always recommend you do. We have Remen's wholesale link here that you can click on, and another link for our underwriting help desk for Remen so that you can ask scenario and ask general questions, not only for our VA IRRRL product, but all VA products, our purchases, cash outs, or any other product that Remen offers, such as 203K Streamlines, 203K Full Consultants, FHA loans, USDA loans, etc. So that's really the end of the presentation. We're going to thank you for your time today, and we're going to start a questions and answers piece right now in just 1 minute. So if you give us just 1 minute, we're going to organize our questions, and we'll start with the questions and answers portion. And we're going to try to answer as many questions as we can. For those questions we do not get to, we will be sending out this presentation along with the questions and answers for all of the questions that are asked. So even though we're starting our questions and answers, please continue to send those questions in. And like I said, if we do not get to them now, we will send out an email within a couple of weeks with all the questions being answered.
Hey, Pam. Well, one favor, can you just show the screen that has USA Cares information? A couple of people that wanted to just get that information again.
Sure. Let me just go back real quick.
Thank you. I appreciate it.
No problem. Here we go. You can find it all on usacares.org. Okay. So here is our first question. Is there a seasoning requirement for the IRRRL product? And we're going to have Cheryl answer this question.
Hi, Pam. VA does not have a seasoning requirement, but as Pam stated numerous times in this presentation, you must check with your lender. As Remen does have an overlay, we do require that the borrower has at least 12 months payment on the current VA loan.
Okay, so the next question is, can closing costs be included into the loan amount?
As Pam had stated earlier, yes, closing costs and prepays may be rolled into the loan amount as long as you do not exceed the calculation for your max worksheet, which should be in all of your services that you're using.
Also remember, this is what we call a no-cost loan because you're able to add in the closing costs, your prepaids, the reasonable discount points, as well as the funding fee. And it really is a no-cost loan to your veteran borrower. It's a really excellent loan product, and if you have the opportunity to originate one, I really do suggest that you do that. Can you do a term reduction on an IRRRL?
Yes, you can. As Pam had stated earlier, if your borrower's payment increases by 20%, the veteran is required to credit qualify for this new loan.
However, you are able to do a term. So if the increase in the PITI is less than 20%, the IRRRL guidelines still say where you do not have to credit qualify. You only have to be careful when you're comparing the 20% rule. Is a disabled veteran exempt from the funding fee?
If you pull your documents direct from the VA website, for IRRRLs, you're required to obtain a prior loan validation as well as an IRRRL case assignment. Both of those, if they reflect from the VA that your veteran is exempt, there will not be the 0.5 funding fee.
So be careful when you're talking to your veterans. That's one of these questions that you really need to ask right from the beginning, whether or not your veteran would be exempt from the funding fee. It's one of the questions you should ask right away. Okay, someone asked for us to clarify the 2055 requirement. Now, as we stated before, the VA does not require an appraisal. However, most lenders do because the secondary market requires some kind of value analysis. When I mentioned the 2055 before, that's Remen's overlay. Now, you might want to check with your other lenders, but I will tell you that most lenders will have some type of requirement. A 2055 is an exterior appraisal only. So sometimes a lender will require some type of appraisal analysis. So what happens when the appraisal value does come in low? Well, if the appraisal value does come in low, you might have to try. The veteran may not qualify for the IRRRL product, but they may qualify for regular refinance, under a VA product, or perhaps you could switch them to another mortgage product. Someone asked about credit score overlays. Well, we know Remen has a credit score overlay. However, the VA does not require, so you do need to check your lender's guidelines on that. There was a question regarding surviving spouse loans. Now, as we stated before, if you have an IRRRL product and if you are trying to do an IRRRL and there's a surviving spouse who was originally on the original loan with your veteran and the veteran has passed away, they're going to be the veteran on the new IRRRL loan. So therefore, there is no credit qualifying for a co-obligator spouse. Now, to clarify that even further, if your veteran had a mortgage, VA mortgage, and then got married and passed away, if that spouse was not on the original mortgage, then unfortunately they will not qualify for an IRRRL. So as long as they were on the original mortgage, then they do qualify for an IRRRL. Another question that came in, can you do the IRRRL product for a non-occupant? I guess I'm assuming for an investment property or a second home. Now, the VA does not require the veteran to occupy the property, and so second homes and investment properties are allowed in the IRRRL product. However, the veteran does have to certify that they once previously occupied the property.
We do have one question that says, can we accept cops and firemen as vets? Any person, regardless of their current job, if they once served in the military and you do pull a certificate of eligibility or a prior loan validation, they are allowed to go ahead and get VA financing or refinance on an IRRRL. We also have another question that says, can we add a new spouse to an IRRRL without a credit qualifying? If your borrower has recently gotten married and they can provide proof of a marriage certificate and they would like to add the spouse to the loan, they may do so on an IRRRL or even on a regular refinance.
And then we did have a question regarding REMN correspondent relationships. And that's a question that should be directed to the general scenario question. And one of the sales managers, including Joe Amoroso, whoever met earlier on the call, will get back to you to explain our correspondent relationships.
We do have one specific question directed towards REMN. It asks, what is the max LTV and CLTV that we're willing to do? We have an overlay that the max we will go up to is 110% with a 2055 drive-by appraisal. Again, please check with all of your lenders because each lender does have their own requirements.
Someone just asked the question, who do we ask if the veteran is exempt? You will ask the veteran up front whether or not they're going to exempt for the funding fee. And if they are exempt from the funding fee, then you will need to contact through the VIP, that Veterans Information Portal. You'll contact the VA and request to see whether or not the veteran is exempt. The certificate of eligibility is not required. However, the certificate of eligibility, if you do get one on an IRRRL, will let you know whether or not the veteran bar is exempt.
We do have one question that says, is there a different funding fee for military reserves? If you're doing an IRRRL, the funding fee is a flat 0.5%, regardless of what type of military your borrower was in. But please note, if you're doing a purchase or a cash out, the VA funding fee does change based on the type of military and whether or not it was a first or subsequent use.
Okay, we seem to be getting a lot of questions on the energy efficient mortgage section, which I think is great because it is a wonderful product. We'll answer those all in writing because there seems to be a lot of questions about that, and that may be another good seminar to produce. So we will also send this presentation out along with any other questions that we will continue, any questions that we continue to get. While the seminar is still going on, we will answer all of your questions. So in the next couple weeks, we're going to send out this presentation, which will have all the links onto it, to USA Cares, to the VA website.